Here's the take from RBC and Tom Narayan. Investors continue to expect there won't be permanent tariffs. Automakers can handle them if temporary, but if permanent, would be problematic for the US auto industry. Tom's back with us around the table. Tom, it's good to see you as always, sir. Good time for a $6 billion buyback?
For GM? I mean, it would appear so. The market liked it. And, I mean, it was telegraphed that they would do that buyback. And I think it is indicative of what we're seeing from investors, right? There's no expectation that these will be permanent tariffs. The automakers said they can handle short-term tariffs, right, that last a few weeks, et cetera. And that's, I think, what people are baking in, that we may have them, but they eventually will end in some sort of a deal between governments.
It's such a strange moment because so many people don't believe it happens, and then they believe if it does happen, it won't last very long. Where does that all come from? Why don't we believe what the president is selling going into next week?
Well, we saw what happened when the initial announcement happened, right? The market pretty much tanked, right? And then immediately you had, actually, it's delayed. So I think there's an expectation that the administration doesn't want to tank the economy, doesn't want to tank the market, and that maybe cooler heads might prevail, just like what we saw, by the way, in the first Trump administration, right? So I think that's what investors are thinking, and they're also rationalizing by saying, who exactly are you helping with the tariffs? Which U.S. industries actually helped? And that's what they're thinking, that ultimately the administration will be more pragmatic and look for a deal between governments as opposed to trying to penalize the U.S. auto industry.
Can you quantify how much these tariffs are actually priced in any capacity to the auto manufacturers' shares?
A very small amount, but some of it is factored. The reason is, if they're permanent tariffs, I used the example before of this negative infinity case.
Love that.
Right. They would be so disastrous, double-digit hits to earnings. We're definitely not having that in our earnings estimates that we're seeing from the sell side, the consensus, but we are seeing some downside that's happened, maybe a few percentage points. So if there are no tariffs, there's actually a reason to be constructive on the space. Obviously, if there are permanent tariffs, it's the opposite.
Well, this to me is such a fascinating point. It's sort of John's idea. If you really think that Armageddon is happening, you might as well buy tons of stocks and go completely risk because you've got nothing to lose. I guess at a certain point for these car manufacturers, why don't they all go GM? Why don't they all just buy back their shares and say, look, why keep some dry powder when you can't really prepare for Armageddon? So, you know, here you go.
Well, I think GM is in a different position than some of these other automakers. We saw Stellantis earlier in the week, et cetera. GM is
looking good.
Yeah, very healthy balance sheet from GM. They're selling stuff that people want with very high profit margins. They didn't go crazy with high pricing. They were disciplined. And they can manage a near-term tariff issue by keeping stuff in the U.S. So I think that may be a different story. But to your point, yeah, why not overlook this? I think investors are overlooking this. I think investors, for the most part, are staying in the sector, and they're hoping that cooler heads will prevail.